All right, welcome everybody back to Simple Fund 360 Education Week. If you do not know already, BGL is running the SF 360 Education Week all throughout this week, and we're approximately at the midpoint right now. Today's topic will be on end-to-end depreciation management. My name is Daniel. I'm a member of the training team here at BGL Corporate Solutions, and I'm joined by a number of colleagues here to help me out with some of the questions. So firstly, we'll just run through some housekeeping matters. As you can see, this is Simple Fund 360 Education Week. We've gone through approximately 7 or 8 topics so far, and we do have a number to go. So if any of these do interest you, feel free to register for the webinars. Otherwise, there will be recordings available, which I'll just go through in just a moment. But as I mentioned, there will be questions available during the webinar. All attendees are on listen-only mode, so if you do have a question, please do use that Q&A feature in Zoom itself. I have members from the Simple Fund 360 product team, client success team, the support team, as well as the training team as well, who are more than happy to answer your questions. So feel free to send those through, and we'll get those answered as soon as we can. The other note is that this webinar is recorded and will be uploaded to the BGL community. I'll just bring across this link here. So this is one of the posts that we have on the BGL community that links to the playlist for all the webinars. So once they all get uploaded to BGL's YouTube channel, they'll all be included in this playlist, and you'll be able to review those after they're uploaded there. So I'll just paste that link into chat if anyone was interested, and we'll move right along. So there is the general link for the BGL community, which you can access through the link that I have posted in chat just then. So for today's webinar, it's all about depreciation. We're going to begin by entering the existing depreciation for a fund that is just being entered into Simple Fund 360. So you might be transferring from another fund and entering the details for these particular properties, and you wanted to enter depreciation that already has been applied. Next, we'll look at processing depreciation in the current year, so the various methods that you can use to do those, as well as finally, we'll look to sell a property, so posting depreciation up to the date of sale and making sure that one is sold with the correct accounting and tax consequences for that one there. So firstly, here is just a little table I've made for the methods for entering existing depreciation. So you're setting up opening balances, you've entered the properties into the fund, and you're hoping to record any existing depreciation for these properties. So there are 2 general methods for these. One is through manual transactions, and one is using the depreciation schedule. Now, these notes will be available to you in the slides that are also provided with the recordings for this particular webinar, and we're actually just going to run through that process right now. So I'm going to switch over to Simple Fund 360 and we'll get started. Perfect. Okay, so we're in Simple Fund 360. I'm just going to double check my screen share just because we had a question saying that the screen was blank. Looks like it should be all good. Please let us know if you have any further issues there. Audio is coming across. Okay, I might just start it up again. Let's see. There we go. I do hope that is now showing for everyone's screen. I've just restarted that one now. Perfect. So we'll get straight into it. So what we've got here in front of us is Simple Fund 360, and it's just basic details for an opening balance. So in these 2 transactions down the bottom, we've recorded a member balance as well as recorded just an amount to the bank. This is just for demonstration purposes. And we do also have 2 properties that we'll be managing throughout this webinar. In terms of actually recording the properties, so adding them to the fund, it is just done through the regular process, and I'll actually just quickly run through that now. So if you're going to create a new journal, all you need to do when selecting an account is choose to add a new account, and then you have the option to add a property. This will bring you to the property dashboard. I'm just going to hide this here. And from this point, you can actually add a new property. So you can select add new property on the right side. where you can enter the address, desired security code, and the details for the property. Once you choose to add the property there, it'll be added similar to these two properties in the dashboard here. And from there, you can go back to the transaction, search for the particular property you're after, and then input that purchase. That was a very brief rundown. I do have this article here about how to record properties when entering opening balances. That'll also post into the chat as well if you wanted to review that. But we are focusing on depreciation, so we'll jump straight into the depreciation methods here. So as I mentioned previously, there are two main methods for posting existing depreciation. The first one is through manual journals. So what we're going to do is record two depreciation journals to record the existing depreciation for the property, and then we're going to make sure that the value of the property is correct. So what do I mean by depreciation journals? In the new transaction option here in the top left, you can see you have bank statement, journal, depreciation, and corporate action. Depreciation is the one we're after, because this is the only type of transaction that will affect the depreciation amounts to a property and in turn affect the CGT cost base. So we're going to select depreciation journal, and our first journal is going to be what we want to show in the operating statement for the opening balances. So this is the comparative period. So our opening balances, are on the 2020 financial year. So we're going to select 30th of June, 2020. We can just leave the reference as what you desire, and we'll choose depreciation comparatives opening balance. For the first account, we're going to select the depreciation account, which is 33400, and we're going to select one of our properties, and we're going to enter a debit amount for this depreciation. So we want 2,000 to show in our comparatives, so we're going to enter a 2,000 debit. Now the other side, if I try to pick any other account, then the system will prompt us saying that depreciation transactions require depreciation expense or an asset account. So the account we want to use for this one is the property account itself. So 77200. If you try to use any other random account, the system's going to prevent you from doing that. And all we need to do is enter that balance into the credit side. So that is our first transaction, recording the comparative amount of depreciation. You won't be able to see that transaction because it is a depreciation transaction. So to view those, you do need to click the filter on the far right side to show depreciation journals. And as you can see, that's our transaction up the top. So we have 2,000 for the comparative period, but we're saying that the total amount of depreciation is 10,000. So we need to add another 8,000 on top of this. The way we do that is we add another depreciation journal, and we're going to input that prior to the opening balances period. So we're going to select the 2019 financial year, 30th of the 6th of 2019. The reason I'm able to do that, now this is a little bit of a workaround here, is I've set the start of my financial year to the year before. So it encompasses both the 2019 and 2020 financial year, just so I'm able to post transactions in both years. So we're posting a transaction in the previous financial year. So we're going to choose existing depreciation just as a description, selecting the exact same accounts, and inputting that 8,000 in depreciation. So it's the exact same as the other transaction. It's just that it's in the prior financial year to the opening balances. So one in 30th of June 2019, one on 30th of June 2020. Now, as you can see in both of these transactions, they have actually reduced the value of the property account by a total of 10,000. So we need to rectify that. So what we can do there is then post an adjusting journal in the opening balances period, and we can say adjustment for existing depreciation. We're going to post to that property account, 77200, increasing that value back up to the correct amount by 10,000. And on the opposing side, we'll just post it to a clearing account, which is the profit and loss allocation account. This account is an account that will be cleared out to zero at the end of the financial year. And since it's in opening balances, we won't need to worry about this account. So we're just going to post that adjustment. It'll prompt you with a message, and that is all good. So with these three journals, one for the comparatives, one for the rest of the existing depreciation, and the adjustment, it'll add the existing depreciation to that property. So let's have a look and see what that looks like in the report screen, just to confirm that we've done that correctly. We'll generate the unrealized capital gains report. So this will show us the details with the tax deferred or depreciation that have been applied to a property. And you can see up the top for property 1, this is the one that we've been posting transactions to. We have the cost of 100,000, which is the cost that was entered here. And we have the tax deferred or depreciation of 10,000, which is the total amount that we've posted in these two transactions here. So that is all done correctly. And as you can see, it has calculated the CGT cost base being 90,000. So we're happy with that there. That is all sorted. But I did mention there is another way in order to add existing depreciation. For that, what we will need to do is start beginning our processing in the first reporting period. So we've finished up opening balances. We'll go to fund details and change it to 2021, which is the first reporting period. If we were to go back to accounting and to transactions, we don't have any transactions in the current year, but we're going to enter our property into the depreciation schedule and start managing it from that screen. This is done by going to compliance on the left side and going to period compliance. From this screen, we can select depreciation on the right side, which will bring us to the depreciation schedule. And we do have entries from when I was previously completing this, so I will actually just remove these. My apologies here. Get them out of there. Okay. So from this screen, we can choose to add a new asset. Very similar to the other transactions, we're searching for that property that we're looking to add depreciation to. And this time we're going to select the second property. So for this one here, you'll notice there is a section saying that there is accumulated depreciation as at 30th of June 2020. This is because the purchase date of this particular asset is before the system start date in the fund. So it notices that this asset was purchased before this fund has begun processing. So it's going to prompt you to enter that accumulated depreciation. For this one, we're just going to enter 20,000 into this field here. And you don't need to choose the depreciation method at this point in time. This can be adjusted, so we're just going to select no depreciation and click save. So as you can see, it has calculated now that it has a opening written down value in this financial year of 180,000, which is that 200,000 less the accumulated depreciation to this point. So for the first method, we would highly recommend using that method when you're looking to process properties using the worksheet function, which we'll go through in just a little moment. But if you're just managing the individual assets as well as separate depreciable assets, you can do it by adding a new asset and then entering that figure in there. So that is both methods to enter the existing depreciation into a fund, and we'll now get into the current period depreciation. So, very similar to the previous step, there are three methods available to process the depreciation in a current year. That is to manually enter the figures, to use the depreciation schedule to calculate depreciation for individual assets. So that's the property on its own, assets on their own, or you can use the depreciation schedule and add a worksheet for one property, which includes all the assets as well. In terms of the manual depreciation, I will run through that very quickly. What that would require is that depreciation is calculated outside of the system and you simply enter in those figures. So if you're entering a depreciation transaction, you go to the transaction list, new transaction, and select depreciation. From there, you're selecting whatever date is required, whether it's at the end of the financial year or partway through the year if you're selling the asset, and then selecting the depreciation account. So that account, the other side is the property itself, and you'd simply input the amount of depreciation into the transaction. That is very simply how you enter the depreciation manually in a transaction. Now, some people may be asking, what about Div 43 capital works? How do you enter those into the fund? That is done via a tax adjustment. So we go to compliance and back to the period compliance screen for these, and you'll notice there's the tax adjustment button here. If you click on tax adjustment, you can choose to add another tax adjustment, and you can select specifically those fields, those labels in the tax return for D1, which is the deductible, and D2, which is the non-deductible capital works. You will need to calculate how much is deductible and how much is non-deductible, and have that put into the tax adjustment. So again, we can select the property, choose to add another, D2, and add that amount in as well. This does need to be done before completing the create entries process, because if you create entries first to the end of the financial year, then you'll be locked out of creating tax adjustments here. So that's the manual process for adding transactions there. Let's go through using the depreciation schedule for a variety of different purposes here. So what we're going to do first is probably one of the more common ways of completing this, and that is to use a worksheet to manage a property. What we can do there is to click New Worksheet on the top left, and we're going to search for our property account. So that is Prop 1. We're going to use this one here. And from here, we can start entering assets that exist in the cost base of the property. So what this assumes is that how you've recorded the property so far, all of the assets are included in that cost base for the property, and you're simply going to take a portion of the cost base out and depreciate it based on a certain method. So our first asset, we're going to say, is the air conditioning. We'll just set the asset code to aircon, say the purchase date is on the date of the opening balances as well. Our opening cost is 3,000. Our opening written down value, so the existing depreciation that has already been applied, is going to be a total of 500. And the closing written down value will actually be calculated itself. For depreciation method, we can just select one of the depreciation methods here: prime cost, diminishing value, so on and so forth, low value pool, capital works deduction. This one will just select prime cost at 10%. And we can click Add to Registry. You'll notice that the closing written down value hasn't been calculated there. It'll calculate after we post the depreciation once it's completed. So I'll just complete it for another asset. So we'll go for the carpet here. Exact same date. For 2,000 opening cost, 1,500 opening written down value. So this one also has 500 existing depreciation related to it. And we'll select diminishing value at 5% for this one, just to make it a bit different. And finally, what we'll do is we'll select the rest of the asset for capital works. So we'll say the asset's name is the property. Asset code can be capital works. And we'll input the cost. So that's the remaining cost. You can see there's a residual cost amount here, which is the total cost less any of the current worksheet items you've entered. We'll input 95,000. We'll input the capital works deduction method of depreciation at 2.5%. And the opening written down value, the remaining amount is 86,000. Because there is 9,000 existing depreciation for the actual property, and then 1,000 for these two assets down the bottom, which equals the total of 10,000 that we've already entered into the fund. Once we've entered all these, we have a residual cost of 0, And we can close that one now, which will then add our worksheet to the depreciation schedule. So it has calculated depreciation of these values. So there is the calculated depreciation overall, and for each individual asset, it has calculated depreciation for those sections. If we were looking to post that depreciation, we can select that asset on the left side and click Post Depreciation. And we'll set it to the end of the financial year, which then will fill out the post depreciation column because it's posting it for the full asset, and the closing written down value as well. So that is the worksheet method for managing that one. I do have a question here. What does the recalculate button do? The recalculate button will actually recalculate calculated depreciation and closing written down value based on values that you've entered there. So if you're unsure if any of the changes that you've made have applied, you can click the recalculate button and will basically make sure all of those details are correct. So we're happy with that worksheet item. That has been entered and all good. We'll mark that as reviewed. Now for this second one, what we're going to do is first add a separate depreciable asset, and then we'll look to process depreciation to a certain point and sell the property. So what we first need to do is add that separate depreciable asset. So we'll open the transaction list right now, and we're going to add that asset in a bank statement. We're going to say that this asset was purchased on the 1st of August in that financial year. Purchase oven for Prop 2. We can select our bank account, and we haven't actually set up that particular separate depreciable asset yet. So we'll choose to add new account, and we'll just select investment for this one. From here, you can select the relevant account. I'm going to select the fixtures and fittings unitized account. Another common account that's used is the plant and equipment, but I'm going to select fixtures and fittings. And you'll notice it'll ask you to select a security. A security is required to automatically manage the market price or the end of year value of this particular item. And if you're creating unitized accounts, you will need to set up a security in order to manage these separate depreciable assets. So I'll click Create New, which will bring us to the security screen. And all we need to do is enter these details. So for our name, we'll do Prop 2 Oven. For the security name, we'll say the Property 2 Oven. And for the market type, we can go to the unlisted, and we can select the unlisted and direct property. You can select the market type that's associated to you, but the common ones are unlisted and direct property. Otherwise, you have the option for miscellaneous there. After you've entered that, you can click Save. It'll bring you back to this particular screen where you're adding that investment, and you can search for that particular asset, which is Prop 2 Oven. There are some other assets that have been added into this firm. That's why they're showing up in that screen. So this is the security we've just created for that separate asset. It'll show you the details for the investment code as well as the name for that one there, and we'll click Save. And now we just need to process the purchase of this separate asset. So we'll say 1 unit, and we'll enter it at 10,000. Very expensive oven. It'll show the investment purchase details underneath, and that is all good. Now, in order to manage this particular depreciable asset, we do need to make sure that it is recorded correctly in the chart of accounts. So we'll go to the chart of accounts and actually search for this asset. You click on the actual asset account and click on More Details. So there are some more details that we do need to manage here. The asset subject to CGT, it is not subject to CGT because the CGT will be occurring when we sell that property. And the depreciable asset, we can tick the depreciable asset option there. This will allow us to connect it to that property 2, that main asset that we do have. So after you select that as a depreciable asset, we can go to the main property account, which is this one here. Click on More Details, And under depreciable assets on the right side, we can search for the oven. And that will add it as a depreciable asset for this property. So now that's completed, we can go back to our depreciation screen. I'll just refresh this one, and you can see that the property to oven is now showing up on this screen. So now we can organize this to make sure that depreciation is being calculated correctly for these two assets. For this property, we'll just select it. We initially had no depreciation, but we'll change that to the capital works deduction at 2.5%. So that's at calculated depreciation of $5,000 right now, and we'll manage the oven as well. So the purchase date that we entered was the 1st of the 8th, 2020, and it's actually going to locate that transaction and see that the current year purchase price was $10,000. We can set that the depreciation method was diminishing value and enter a depreciation rate. Now it has calculated depreciation and it has calculated in a pro rata basis. So because this was processed through the financial year, it's only going to calculate depreciation from when it was purchased till the end of the financial year. So in terms of that, we're going to quickly run through how you would go through selling this. So you'd be selling this particular asset and this oven would be coming along with it as well. In terms of that, we'll just jump quickly back over to the PowerPoint right now. Selling the property, you're posting depreciation up to the date of sale, which is either done through a manual calculation that we mentioned earlier or automatically completed via the schedule. Then you're clearing the remaining depreciable assets to the main property's cost base. And from there, you can process the disposal of the property, in which it will calculate the consideration based on all the depreciation you've entered and the cost base of the property there. So we'll jump back over to this screen. And let's say that we sold this property on the 2nd of January. So all we need to do is select both of these assets here, click on post depreciation, and we'll enter depreciation to the day before. So that is the 1st of the 1st, 2021, because it's being sold on the next day. If we click post for this one here, you'll notice that it's changed its calculation of calculated depreciation because it's not doing it for the full financial year. So it has posted less than what it would be if depreciation was being done to 30th of June. And it has posted that depreciation. If we go back to the journals here, I'll show you the worksheet journals that have already been processed, as well as those other, the ones that we just posted. Remember that you do need to select the depreciation journals, as well as for the capital works, because they are tax adjustments, they show up as nil journals here. So you can see that the property to oven depreciation is posted here, and the worksheet amounts 375 is showing here. So what we need to do is then process a transaction to move the cost base of the property to so we're disposing of the separate depreciable asset and moving that to the property. What we're going to do is take the closing written down value here. So that's the 9167.57, and we're going to use that in a transaction. So we're going to select new transaction, journal, set it for the date that we require. So that was the 2nd of January, 2021. Write off separate to property. We're going to select that oven asset. So that is the 72650 account for fixtures and fittings. Input that we're selling that 1 unit for that amount of 9,167. And we're going to, on the other side of the transaction, add it to the cost base of the property. So that is property 2. For the cost base adjustments, because we're increasing that, we need to enter 0 into the unit and debit for the same amount. If we go down the bottom here, we can choose to select the parcel. And you can see we can select that property that we've previously set up. So you've entered the credit side, disposing of the oven, and you're adding it to the cost base of the property. Then you can select the parcel in more details and click post. Now, as you can see, there is a certain amount of changes in market values to assets, which is actually nullified by the unrealized gain write-back that has occurred there, and that is related to the depreciation that has occurred for that particular asset. It's already been recorded in the changes, so in the expenses to depreciation, so we don't need to worry about that 24800 that's showing up there. Finally, all we need to do is record the sale of the property. So that we can do via a bank statement, and we can say sale of property to bank account. We'll just select that bank account that we have, and we can select the property. So we're disposing of that one unit, and let's say that the benefit we gained from this one was 120,000. Sold it for a little bit of a gain. Scroll down into the more details section. You can see we have the disposal details, and it has calculations based on this one here. So this one actually has been calculated at a capital loss of 66,000, which includes all depreciation that has been posted for this property of 22,000. So when you scroll down in a disposal transaction, you can see the tax consequences down the bottom, as well as calculations relating to that. After we've entered that, you can see that the system has calculated the changes in market values for accounting purposes. So it's showing that there's an $89,000 loss overall for this particular sale because the sale amount was lower to the cost base of that property. All we need to do now, now that that property has been sold, is we can review it in the realized capital gains report. So we'll go to the report screen. I'll just type in realized, and we can see the realized capital gains. So in this screen, we can see that the oven has been disposed of, and there's no consequences for tax. But we can see also that the property has been disposed or sold, and we can see that the cost of it was 209,000, because that is the 200,000 from the property plus that 9,167 from the oven. Total proceeds we got from sale was 120,000, which means we had an accounting loss of 89,000. We do also have the adjusted cost base. So the adjusted cost base is the accounting cost base less the depreciation that has been posted. So that has been reduced to 186,000, which results in the tax capital loss of 66,000. Now, I highly recommend using the realized capital gains report, especially when disposing of properties, to ensure that each figure here is correct, to ensure that you have the accounting cost base, accounting profit and loss, and the adjusted cost base here correct, just to make sure that all those details are correct, because when you create entries, then that flows through to the tax return, as well as to the members, the profit and loss that's allocated to the members there. So the realized capital gains report is incredibly useful. Jump back over to the slides now. So that's just finished up selling the property there. In terms of the PowerPoint, I do have some more helpful links that are available to here, which is the processes that I've run through today, details and instructions about how to enter depreciation, how to use the depreciation schedule, how to record asset depreciation using the worksheet or separate depreciable assets, as well as recording at that written down value. So recording at that lower value and including the existing depreciation. So these are definitely really helpful links here. And the last one I've actually linked here is a CGT cost base adjustment. So let's say there's a situation where you look at the realized capital gains report and the CGT cost base isn't what you think is correct. There might be some issues that have happened previously. Something might have been entered into the software properly. Something might have gone wrong along the way. There is a way to adjust it to make sure that it is correct for the sale, so that it calculates the correct tax gain or loss. So this is the CGT cost base adjustment article. It has simply instructions for 2 different methods that you can use to adjust the CGT cost base method. CGT cost base overall, sorry, but that will be linked in the slides itself. Overall, if you do have any further issues with that, feel free to jump on the live chat or submit a support call and just let us know that you're having issues with a property and you're looking to have depreciation recorded, or you think the CGT cost base to be something else, and we'd be happy to help in order to make sure that's correct for you so that you can then process to the end of the year. And that is it for depreciation. It was a very general overview, but it did cover generally what you would encounter in the lifetime of a property. I'd like to thank the product team members as well as the support and client success team. I understand they've been answering questions throughout this webinar, and hopefully they've provided you with the information you need. I will leave the session open for a couple more minutes, just if you had any further questions. Otherwise, if you do have any other questions that you might think of after the session's been closed, feel free to contact us via the live chat or by submitting a support call, and we'd be happy to answer your questions there relating to that. But yeah, thank you very much, everybody, and I hope you got something out of today's session.